They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a billion-dollar mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. Y'all, I have good news and I have bad news. And let me start with the bad news. There is no housing bubble. Anybody waiting for home prices to drastically drop? Stop waiting. I have been fielding phone calls, text messages, and emails for the past 7 years. People talking about when's the housing bubble gonna burst? When are home prices gonna come down? That's not happening. And if it does, it'll be in select, teeny tiny pockets throughout the US, and it'll be very temporary, and it'll be small compared to what we all witnessed back in 2008. Now, is housing less affordable? Yes. Is that a concern? Yes. But you know what? Everything is going up. Rent is going up. The price of cars are going up. So there's no housing bubble. But if you want to talk about how we can make home ownership more affordable, how we can make home ownership more attainable, oh, I got your back. This is the DO Show. If you're interested in purchasing a home, or you want to find ways to make home ownership more affordable, by tuning into today's show, I'm going to hook you up with the knowledge you need. Today's episode, the truth about housing affordability, why the bubble talk is just crazy. Look, everyone's talking about a housing bubble. You've seen the clickbait. Prices are too high. Rates are unsustainable. Crash incoming. Let me say this clearly. That's crazy talk. We don't have a housing bubble. Now, what we do have, we have a housing shortage. For the past 15 years, builders have not kept up with the number of new households being formed in America. That's a simple supply and demand issue. We learned that in 4th grade. Low supply plus steady demand equals high prices. And look, if we ever do see another housing bubble, it won't be for at least another 10 or 15 years. Why is that, you ask? Because the next time housing takes a major correction, it won't be from bad lending or reckless building. It's going to be from demographics. You see, we have baby boomers who are currently the largest owners of real estate, like they own the biggest percentage. And at some point, as those baby boomers' lives come to an end, 10 to 15 years from now, all of those homes are going to start hitting the market. And as those boomers age out or they pass away, the next generation after them would be millennials. But by this time, millennials are already in their homes. So then we're looking at the Gen Z. And the Gen Z population is actually smaller than the boomer population. So you can see where we could have a surge in supply of homes hitting the market, but not for about 10 or 15 years. So that's not today's problem, right? That's the problem for 10 or 15 years from now. Today's problem is affordability. And the good news is we can fix that right now. So let's talk about it. Let's start by busting the number one myth. That's the 20% down lie. You've probably heard it your whole life. You need 20% down to buy a home. Wrong. Here's the truth. There are no to low down payment options available for almost everybody. Let's go ahead and break them down. My favorite zero down payment option, it's the VA home loan. But you have to understand, VA home loans are only for qualified active duty military, as well as veterans and eligible surviving spouses. It's not available just because your father, mother, uncle, or grandfather served our country. You personally must meet the VA service eligibility requirements. Now, There is no down payment required when you're doing a VA home loan. There's no monthly mortgage insurance, and the interest rates are very competitive. Now, VA home loans do include a one-time VA funding fee, but that can get rolled into your loan. And for some qualified veterans, they're exempt from having to pay that funding fee. Now, the second most popular zero down payment option is a USDA home loan. Now, USDA home loans, you have to understand, are only for homes that are located in USDA designated rural areas. The property must meet location requirements, and there are income limits for buyers. Now, like FHA and VA home loans, there is an upfront fee, and you'll pay a small monthly fee. Now, the second most available and popular 0% down loan option is a USDA home loan. USDA home loans are for homes that are in rural areas as designated by the USDA. So that means the property must meet certain location requirements, and there are income limits for buyers. Like an FHA loan and a VA loan, USDA loans have an upfront fee and a small monthly fee that needs to be paid that's very similar to mortgage insurance. Now for the most common low down payment options. The first one I should talk about is conventional financing. Conventional financing allows you to purchase a home with as little as 3 to 5% down. These loans are best suited for borrowers with strong credit scores. Unlike an FHA loan, when you're putting less than 20% down on a conventional loan, your mortgage insurance can eventually be removed once you reach a sufficient equity position in your home. And we'll talk about this later, you can even buy out the necessity of paying monthly mortgage insurance. So then that leaves an FHA loan as our next low down payment option. It only requires 3.5% down. It's easier to qualify when it comes to credit, as it is more generous for lower credit scores. Now, FHA loans do have an upfront mortgage insurance that gets rolled into the loan, as well as a monthly mortgage insurance premium. And finally, let's chat about down payment assistance programs. Just about every state in America offers some form of down payment assistance. These are often grants or forgivable loans that help cover the down payment or closing cost. There is one catch when it comes to these down payment assistance loans, by the way, also called DPA. Most DPA programs are tied to your local area median income, or what we call in the mortgage industry AMI. If a program caps the eligibility at 80% of AMI, it's harder to qualify, especially in high cost areas. But if you have a down payment assistance program that allows for 120% of AMI, it opens the doors for financing to more middle class families. It's all about what options fit best for you. So before you assume you need $60,000 saved up to purchase your first home or to purchase your next home, make sure you talk to a good lender. You might qualify for a home loan with zero down, or you may have just enough right now to cover the down payment in order to get yourself into a home, knowing you may only need 3 or 5% down. So now that I've dispelled the myth that you need 20% down to purchase a home, and even given you some ideas of what types of loan programs allow you to buy a home with 0% down, 3% down, or even 5% down, let's talk about how we can make homeownership more affordable. And the first step to making homeownership more affordable is understanding how to leverage seller credits to cover closing costs and to lower your monthly payment. A seller credit is when the seller agrees to contribute a portion of the sales price towards your closing costs. Typically, anywhere between 3 to 6% of the purchase price is what a seller would be willing to contribute. The amount the seller can contribute also depends on the loan type. For example, conventional loans, depending on your down payment and the product type, will allow anywhere between 3 and 9% of the purchase price to be applied towards closing cost credits. But if you're buying an investment property, it may only be a 2% maximum towards closing costs. Now, when it comes to FHA home loans, FHA allows the seller to contribute 6% of the sales price towards the buyer's closing cost, regardless of how much money or what type of down payment the buyer is contributing towards a transaction. When it comes to VA home loans, many people will tell you the maximum is 4%. That's actually not true. When it comes to paying closing costs, the maximum that the seller can pay towards a buyer's closing cost is actually whatever is common and customary for that area. Where a lot of lenders and banks will want to tell you that the maximum contribution is 4% when it comes to VA, that's because they're confusing a seller credit with a concession. A concession would be something like this. If you buy my house, I'll give you my tractor. If you buy my house, I'll give you my golf cart. If you buy my house, I'll give you all the furniture. That's a concession. So when it comes to VA home loans, there is a maximum 4% concession, but when it comes to your closing cost credit, VA actually is the most flexible because they don't put any type of parameters on it in terms of 1 or 2 or 3%. They just say whatever's common and customary for your area. So let's talk about closing cost. Like this money we're getting from the seller, what can it actually be used for? Well, when you're purchasing a home, you're gonna have closing costs to your lender. We typically call those origination and underwriting fees. There's gonna be some kind of a title or escrow company, maybe even an attorney involved. They're gonna have their fees. Your state, your county, they're gonna have fees and taxes associated with you purchasing real estate. You're gonna pay for an appraisal, more than likely a survey. If you're buying in an HOA, your HOA may have some upfront charges. You're gonna have to pay for your first full year of homeowners insurance, plus you're gonna have to put money aside into an escrow account for future real estate tax and homeowners insurance payments. Typically, closing costs run between 2 and 3% of the home's purchase price. So on a $400,000 home, I would tell you you're somewhere between $8,000 and $12,000 in closing cost. Now, you can also have optional closing costs like discount points or upfront mortgage insurance premiums. So when a seller offers you, let's say, $10,000 credit to go towards your closing cost, it's not like it's free money, but it is money that was worked into the sales price that you can now use strategically to make your home more affordable, whether it's to pay your closing cost or lower your monthly payment. Now let's talk about 3 smart ways that you can use a seller credit. So when a seller offers you a closing cost credit, typically it was to cover those $8,000 to $12,000 we just mentioned. And keep in mind, it's not free money. You did negotiate with the seller to pay this on your behalf. You probably had a choice. You could have got the home for a little bit cheaper, or you could have negotiated with the seller to give you this credit. Many times, it's most beneficial to pay a little bit more for the house in order to get these credits, because the little bit more that you're paying for the house probably only cost you about $70 a month on your payment. However, you're getting $8,000 to $12,000 to cover all of your upfront closing cost, making the only money out of your pocket that little bit that you had to come up with for your down payment. So that's the most basic way to use a seller credit to make homeownership more affordable. But there's 3 even smarter, more savvy ways that we can use a seller credit to make homeownership more affordable. The first strategy is just buying out your mortgage insurance. As you know, and as we've taught before, when you put down less than 20% on a conventional loan, you are gonna have to pay monthly mortgage insurance. Now, usually, monthly mortgage insurance is anywhere between $100 to $300. It all depends on your loan amount, depends on how much money you're putting down. But here's the hack. You don't have to pay it monthly. You can actually buy out your mortgage insurance by paying one lump sum up front, and you can use a seller credit to pay for that entire buyout. That means going forward, you will not have monthly mortgage insurance. That means going forward, your monthly payment is now $100 to $300 cheaper per month. But keep in mind, this only works best on conventional loans. You don't have this ability on FHA loans, and on VA home loans, there is no monthly mortgage insurance. But when you're doing a conventional loan, you 100% can strategically negotiate with the seller to contribute enough money towards your closing costs that not only will you be able to have 0 closing cost, but also use a seller credit to buy out your requirement to ever pay monthly mortgage insurance. Now, the second strategy is by far the most popular and the most well-known strategy. It's called buying down your interest rate. You can also use a seller credit to permanently buy down your interest rate. Here's how it works. You pay discount points to your lender. Discount points is something you pay upfront one time, but it lowers your interest rate for the life of your loan. One discount point equals 1% of the loan amount. Each point typically lowers your rate about 1/4% and sometimes all the way up to 0.5%. So if you're buying a $400,000 home and the seller gives you $8,000 in seller credits, that's 2 points. You could lower your rate by roughly half to a full percent depending on what's happening in the market that day. That could save you $200 to $400 a month, making homeownership more affordable. And the best part, you're not paying for it. The seller is. So instead of waiting for rates to come down, you bring them down yourself and you buy now when you're ready. So this third strategy is by far the most creative and not one that many lenders actually know about. You can have the seller pay for the first 3 months of your mortgage payments. This one's a game changer. Under certain programs like FHA, VA, and USDA, the seller can use their credit to cover your first 3 mortgage payments. So let's say you buy a home in January. Now, normally when you buy a home in January, your first mortgage payment's not due until March 1st. So imagine this, your first payment's due March 1st, but the seller's gonna pay March, April, and May payments. That means your first mortgage payment would not be due until June 1st. That's 5 full months from your closing before you have to come out of pocket $2,000, $3,000, or $4,000 for your mortgage payment. This gives new homeowners breathing room to buy furniture, build savings, get financially settled. But remember, not all lenders can offer this, especially those who sell their loans immediately to aggregators. But lenders who service their own loans often can. So always ask your loan officer if this option is available. Finally, let's talk a little bit about house hacking. This is taking affordability one step further. You can turn your home into an income stream. The term, house hacking. Here's how it works. You buy a property that has multiple units, like a duplex, triplex, or a quadruplex, also known as a fourplex. You live in one unit and you rent out the others. Or better yet, buy a single family home that has an ADU. ADU stands for accessory dwelling unit. My friend Mike has one, and it works perfect for him. It's like a garage apartment or a basement studio, or for some people, it's a backyard cottage. And what happens is you rent that ADU out, and that rental income helps pay your mortgage. For example, if your total mortgage payment is $2,500 a month, but you rent the ADU for $800 a month, your net payment drops down to $1,700 per month. It's one of the smartest ways to build wealth through real estate. And it can all start with the same 3 to 5% down payment programs we talked about earlier. And better yet, what if you coupled it with some of the strategies on leveraging a seller credit to lower your monthly payment? So let's talk about why this isn't 2008. And let's be clear, it's not 2008. Like back then, we had too many homes being built, we had too many bad loans, and too much fake demand. Today, we have 15 years of underbuilding, stricter lending standards, and real demand from people who actually qualify. This isn't a bubble, y'all. It's a supply shortage, and it's going to take years to fix. So if you're looking to buy a home, take action now. Here's my biggest takeaway. You don't need to wait for the perfect time to buy. You just need the right strategy. Use seller credits wisely. Buy out your mortgage insurance. Buy down your rate. Ask the seller to pay your first 3 payments. Homeownership isn't unaffordable. It's just misunderstood. Look, I'm Dustin Owen, and this is the DO Show. If this has helped you see things differently, drop a comment below. Tag a friend who's waiting on the sidelines. And make sure you're subscribed to this YouTube channel, because we're just getting started. In real estate, knowledge isn't just power, it's profit.